So moving on with incomplete records to the second part of this session. This is where we practice some of these markups and margins, that kind of thing. If you remember at the end of the previous page, example number 9, we tried to work out the percentage, how we got to the gross profit, the cost of sales, that kind of thing, particularly the cost of sales. So I need to develop that as we tackle example number 10. First, the facts. Again, try not to look at the solution. So I'll blot out the solution, if I may. If you give me the liberty of doing that. Let's concentrate only on the question. The cost of sales is 600. The markup is said to be 25% on cost, of course. So what is the gross profit, and indeed, what is the sales? Different ways you can do this. It being quite a common feature of the exam, what I'd like to do, please, is to try out a little answer. So if I can move along to a new section, please. Let's say example 10. Still incomplete records. This time practicing our skills on gross profit and net profit margins, that kind of thing. Very easy really, but you must be completely fluent. So it says the cost of sales is 600, the markup is 25%. What is gross profit and sales? So one of the ways of doing it is to say cost is, say, in percentage terms, 100 plus the markup, which is 25, and so I suppose the selling price is 125. So if that is the selling price, and markup, of course, is 25, and then someone says to you that the gross profit needs to be worked out. The cost of sales, of course, is 600. So if this is 600 and the markup is 25, what is the sales? I suppose what you could take is a quarter, 25% of 100, a quarter of 600, a quarter of 600 is 150, and so the grand total, of course, is 750. That must be the selling price. So that is the gross profit. This is the selling price. Any method you like. I've just chosen a simple one. So I do believe that this is the key, doing something like this little section. If you say the cost is 100 and the markup is 25, the selling price is 125. If the cost is then given as 600, what is 25% of 600? It must be 150. And obviously, if you have cost plus markup giving selling price, the selling price must be 750. Or any permutation of that gets you there. Right, let's move on then to examples 11, 12, etc. This time I might go back just for variety and take you through the various questions we have ahead of us. So let's move on then to example 11 first. So one of the fundamental skills with incomplete records is this ability to use percentages, very, very frequently examined. Now, says question, there's a markup of 10%. Whenever they say markup, it means on cost. When they say margin, it means on selling price. So markup on cost is 10%. The sales is 6,600. The opening inventory is 300 and the closing inventory is 500. Required, complete a trading account from the above information. Trading account is like a simple income statement, statement of comprehensive income, that kind of thing. Now, I thought what I might do, just for variety, is to take you into the solution, so you have something in front of you, so you can see how the whole thing works. So here comes the solution. If I may just draw a symbolic line to indicate end of question, start of solution. Sales is 6,600, but we need to concentrate on this question, of course, below that line. So example 11, the sales is given, so I can tick that off. That's from here, you see. The other issue is the opening inventory is given as 300 and the closing as 500. So let's put in whatever we can. Opening is 300, the closing is 500, obviously less closing inventory. Opening plus purchases less closing inventory gives you the cost of sales. So this figure here, of course, is cost of sales, this little number here. Now, what we're going to do is to say that if our let me just take you back for a second. If the markup is said to be 10% on cost, the selling price can be worked out as being 110. So if the cost of sales is 100 percentage points and the markup is said to be 10%, then this has got to be the selling price of 110. So if that's 110 and this is given or virtually worked out, you see the selling price is 6,600. The opening inventory and closing inventory is given as 300 and 500 respectively. How you get your gross profit is to take 10 over 110 times 6.6, and that of course gets you this. Once you get that, then this becomes a balancing figure. You get that, then this becomes a balancing figure. It's as easy as that. I'll go through that again. If your cost is 100 and your selling price is 110 because your markup is 10, that's the first thing you do. What you can then do is to say, well, if my selling price is 6,600 as given, and I'm trying to work out the profit or the markup, I'll take 10 over 110. And the reason for that is quite simple. It's the basic model we've used before. Perhaps I can do it down here. If you have percentages, say, of cost 100, I think it's a markup, isn't it? Markup of 10, then the selling price is 110. So if you want to work out the sales price, what you could do is to get to 110. To enable us to do that, of course, we need to put this into a little fraction. 10 over 110 multiplied by 6,600, which is the selling price. Don't forget the 110 is in terms of selling price. The 6,600 is in terms of selling price. So 10 divided by 110, 1/11th, of course, is the profit element. And if that's 600, you can work backwards and establish that if the 600 is a gross profit and 6,600 is a selling price, the gap between the two, of course, is the cost of sales of 6,000. And if that 6,000 is in place there, the purchases, the balancing figure then turns up as the 6,200 figure. Okay, so it all comes from being comfortable with the percentages. So stop the tape now and just run through that again, please. Not too bad once you get into it. Now, when you're ready, I invite you to move on to example 12. to see if we can do a few more of these things. Let's have a look now. Example 12, the margin is supposed to be 5% and the purchases are 2840, opening inventory, closing inventory. So the best way to do these things is to put down whatever is given. So if I can just draw a symbolic line there to indicate end of question, start of answer. Quite important to know where the question ends and where the solution begins. So let me say that's the end of question. Here comes the start of answer. Margin is 5%. Interesting. So if the margin is 5%, you see this gross profit 5% on the selling price of 100. And if your selling price is 100 and the margin on that is 5, the cost of sales has got to be 95%. You see that? If you're selling it for 100 and you have a margin of 5%, a profit element of 5%, and where it's described on selling price is described as margin, where it's described on cost is described as markup. So let's say 5% of 100 is 5, obviously, and 95% therefore must be the cost price. And cost of sales, of course, is this figure here. Upstairs you have sales. This is the cost of sales, and this, of course, is the profit. So if 95% is your cost of sales, and this is given, and this is given, I suppose the 2840 appears as, in fact, that indeed is given. So all three here are given in this question. So it is possible to work it out just by adding 800 plus 2840 and minusing 600, so that comes to 3040. If 3040 is 95%, what is the big figure of 3,000? So what we've done is we've taken 3040, the answer is taken 3040, and divided by 95 and multiplied by 100. And thereby this figure emerges, and therefore everything just falls into place. So different ways you can get it. Clearly it'd be nice to get your 3,200 worked out. Your 3040, of course, is the difference between the 5%. So I suppose what you could say is 5% of your selling price is proof that that's 160, and so all three of the key figures make sense. So do try that, switch that off please, stop the tape and see if you can make some sense of that particular exercise. Quite straightforward. Always think that if you put in whatever's given and you're absolutely certain that opening inventory plus purchases less closing inventory is cost of sales, you can then work out what you need to work out. And very often if the margin is given as here, you can work out the sales by starting with the cost of sales, which is opening stock plus purchases less closing. So that's how the 3040 is arrived at. That 3040 is then grossed up, if you like, by dividing by 0.95. Or if you prefer, divide by 95, multiply by 100. So that's how you get to 3,200, and therefore the whole thing falls into place. Now, when you're ready, I invite you to move on to the last 12th, I think, exercise here. Indeed, there is a 13th. We're looking at the 13th. Cost of lost inventory. So emphasis on that word lost. In incomplete records questions, it is likely that inventory has been lost due to the infamous fire or flood. So a fire or flood seems to occur quite a lot in examination questions, as we were saying. The closing inventory that has not been lost is subtracted in cost of sales because by definition the inventory has not been sold in the year. Let's read that again. Closing inventory that has not been lost is subtracted in cost of sales because by definition the inventory has not been sold in the year. So let's have a look. Lost inventory has also not been sold by definition because you lost it before you sold it, and therefore also needs subtracting within cost of sales. That's a big word, that, in one sense. Therefore, to work out the cost of lost inventory, complete the trading account from the information given, and then lost inventory can be calculated as a balancing figure. That's very, very important indeed. So how shall we do this exercise? What might be an idea is for you to read example 13, and we'll see if we can do it on a blank sheet of paper. That is always the best proof that we do know what we're doing. So let's have a look at this 13th example in this series as we come to the end of incomplete records. Ahead of us is partnerships, a bit of a revision, and we should then be through with F3. But that is for later. Let's see if we can get this rather important exercise done first. So, as usual, I'd like very much to blot out all of this to concentrate only on the question. So, 20% is a margin, obviously on sales price. So automatically I'm saying to myself, cost must equal 80%. Does that make sense? If selling price is what the margin is based on, sales price, and that is said to be 20% on selling price, let me make the selling price 100 percentage points. So if the margin is 20% on the sales price is 100. So whatever the margin is based on, that figure should be the base figure of 100%. The sales is 100,000. The opening inventory is said to be 10,000. The closing inventory after the fire is 3,000. And purchases are said to be 82,000. Complete a trading account from the above figures, says the question. Quite a tough one, so I thought I might do it from scratch, just to show you that these things aren't too bad after all. So let's open up in our usual solution section an example number 13. Incomplete records. These little bits and pieces for 2 marks and 1 mark and so on. Clearly it'll have to be done quite quickly in the exam, but as I say, some questions take you a few seconds to do. And so this one will stretch you for the time you have appropriate to the marks. So how shall I do this? I suppose I better lay out a nice sales type of figure and dollars there, less cost of sales. And the traditional formula for cost of sales is opening inventory. The opening inventory in this question is given as 10,000. The purchases is also given as 82. So opening plus purchases is some 92. Absolutely straightforward. What else do they give us in this question? I notice the closing inventory after the fire as physically counted is said to be 3,000. So as counted is said to be 3,000. Obviously less like that. And if I can leave 2 or 3 lines, a couple of lines, the inventory lost in fire is the mystery unknown figure here. So I might do a little box to indicate it's a missing figure and to concentrate the mind. That's where we're going. And so once you take these numbers away, this figure here, I suppose, is cost of sales. This one here. Now, miles upstairs somewhere, 5 or 6 lines upstairs somewhere, we had a sales figure, and that's given in this question at 100,000. Mustn't forget to bring that in. So this figure is said to be 100,000. Sales less cost of sales. Now the cost of sales has got lots of parts to it. Opening inventory plus purchases less closing inventory. The cost of sales, be careful, is said to be 80% of the selling price. So I suppose 80% of selling price of 100,000 has got to be 80,000. Needless to say, if you have 80 there and you have gross profit down here, 100 take away 80 is 20. In other words, sales minus cost of sales equals profit, I suppose. So if that is 80% of selling price from our initial percentages, and that's 20 and that's 80, you can see how the whole thing is coming together if you're a little bit careful. So as I work upwards, what I notice is these two things have got to be in the region of how much? 92, 80. Is that difference 12? So these things are meant to be 12 together. And if that's 3, the figure that's missing has got to be 9. Has got to be 9. Different ways you can approach it. There are lots of avenues. But the best way to do it is to say to yourself, now, do I really understand those percentages? If the selling price is said to be 100%, obviously, and that's 100,000 as it happens, and that is, your margin is given as 20%, and the margin, of course, is the gross profit. So 20% of 100 is clearly my gross profit down here. So 20% of 100 is equaling the gross profit of 20. If that's 20, the cost of sales has got to be 80. If the cost of sales is 80, and I've got my framework absolutely rock solid in my mind, this is given, this is given, this is calculated, this is given. The only thing that I have left then to worry about is what was the inventory lost in the fire? And the answer must be, if my cost of sales is 80 and my running total of opening inventory plus purchases is 92, clearly the difference between 80 and 92 must be the closing inventory. And if that's 12,000 and I've accounted for 3 because I physically counted it as counted physically, if I physically counted 3,000, actually counted it, and I realized that I should have had 12,000 because of the way the profit margins work, if I should have had 12 and I physically counted 3, clearly what I have lost in the fire, damage or whatever, is the figure of 9,000. So that's the way this incomplete records topic works. If I can just take you through the various exercises we've carried out with incomplete records. Here we are, just to recap briefly. Any form of accounting records other than full double entry system Accountants come across this kind of thing every day, which is why it's examined every sitting. Calculating profit, the key thing to memorize, of course, is this formula. It all boils down to one simple formula, and that is opening capital plus capital introduced plus profit. So opening capital plus capital introduced plus profit minus drawings equals closing. And if any of them is missing, you can easily work out the missing figure, provided your general format is sound. A bit like when you're doing cost of sales and missing or lost or damaged in fire type of inventory. If you know your format and that format is rock solid, you can work backwards, downwards, anything, and you can get there. But if you're shaky about your foundation, you've got too many models, it becomes quite difficult. I think most of us can work backwards, not only forwards, with a calculator these days. Don't forget to take your calculator into the exam, by the way. I have heard of horror stories of people being stuck without calculators and so on. So be careful. Right, here we are. The sole trader's statement of financial position shows us that basically you're trying to work out profit using that formula. So learn that formula by heart. The second example, of course, once you've seen the number of unknowns, sometimes lots and lots of balancing figures, here we're using accounts receivable to work out the sales for the year. So we are adapting control accounts to get us going here. Example number 3 is very, very similar, but this time, of course, you've got cash sales and credit sales. So the way I would do it is to call it total sales account. And the figure that you have in here can be easily double entried into the income statement. It's all part of incomplete records. One exercise that you will not get, and more is the pity, is where the examiner says to you, here are some scraps of information, I'd like you to convert that into a proper set of accounts. I remember years ago when I started out in accounting auditing, many years ago, I'd be given a cardboard box, a shoe box, with lots of pieces of information, receipts, invoices, and other scraps, and I was supposed to take it away, and a week later, or a few days later, come back with a proper set of accounts, an income statement, a balance sheet as it used to be called in those days, income statement, statement of financial position, plus working papers. That was a fascinating exercise. Just a few pieces of paper, making assumptions, obviously with all the key figures known, and one would convert from last year's capital to this year's capital, and in between, if there's any capital introduced, new capital, or withdrawn as drawings, the difference, of course, is profit. And to enable us to work out things like sales, to do a proper trading account, you might have to use these adapted skills from control accounts. And that basically is the essence of example 3. Example 4 is where you can in fact keep the second part of example 3 is where you keep your various methods separate. Beg your pardon. You can keep your cash sales separated from your credit sales. I don't like that method so much myself. That's still example 3. Example 4, of course, is where we do the same sort of thing, but this time with our payables. So the eventual figure, of course, purchases, is a crucial figure for our trading account, which becomes the income statement. Example 5 then became this very interesting point. The total purchases figure for the year. If you have an opening balance and a closing balance, you've been given some total payments and discounts received. Easily you can put it all together to give you the purchases. Quite useful, I think, to think of the double entry. If you debit your income statement, you're crediting this account, and that holds the purchases on the credit side. Make sure it enters the credit side, because the debit side obviously goes to the income statement. Okay, so that's very easy indeed. Now comes example 6, where we have the average rent and rates. I must say, when I look at these F3 questions myself, when I put myself to the test, these exam questions, it's interesting to see that this one causes a bit of a problem sometimes, because of the fact that you have prepayments and accruals. This particular question isn't too bad because they haven't given us precise dates. But if they give you precise dates like 3 months and 4 months and in advance in arrears, it can cause a problem if you're not extremely careful with the number of months. But we've done exercises like that in recent sessions. So this particular one is more helping our incomplete records sole trader, the sole trader with incomplete records, to produce a full set of accounts, including things that cover rent and rates. So that isn't too bad. Don't forget that when you're closing an account, it always appears on the wrong side, so to speak, to enable you to bring it down to the right side. So don't forget that. That wasn't too bad an exercise. Beyond that, of course, we had example 7. This is where you have to work out things like the amount of money you might have received from your customers. So if you've got an overdraft and you've paid something and you still have a positive balance, don't forget that positive balance comes down to it's on the wrong side to enable you to bring it down to the right side, which is down here, isn't it, in the new year. Don't forget that. So if you've got an overdraft and you've paid things and you still have a positive balance, it must mean you received a huge amount this year. And that's a nice thing, obviously, for the company. But for us in the exam, you mustn't forget that you must use logic as well. Then you come to example 8. There's a cash float. Cash float is just a little bit of money. You give your $900, whatever it is, you give your petty cashier, and he or she spends money out of it, and then at the end of the year tries to work out what the expenses are. How much cash was received from customers during the year? Now, if you've got a cash float of 900 and a closing cash float of 1,000, and you've managed to bank 10,000 and drew 1,000 and had wages paid of 2,000, the simple truth is you've received a huge amount, 13,100. Very similar to the previous exercise. We received lots of cash to be able to spend like that, to pay out, etc. All this on the credit side. And so we move on to markups and margins. Causes huge problems at this level and the next level, and indeed the next level of financial accounting type papers. So you've got to be very careful with this. Markups talk about cost. Margins talk about selling prices. You mustn't confuse the two. It's a little convention. The trading account, therefore, can be made up with a minimum of information, being careful, being completely relaxed about things like 25% on markup. 25% markup is referring to 25% on cost, and so on. And that's basically what that little exercise is showing you. Then comes a clever question, trying to work things out, such as gross profit and cost of sales, where you've been given sales and you've been given a markup, I beg your pardon, in this case a margin of 25%. And so if you have a sales at 100% and the margin at 25%, naturally the cost must be 75%. And you just put 2 and 2 together, calculator in hand, no problem whatsoever, easy mark, that one. What else do we have on offer? Example 10, again, very, very easy indeed. The gross profit and sales, very similar to the previous exercise. This time, however, it's based on markups. So if you put all that together, I think we did some special workings there to get us to that. Looks quite harmless, that question, but you've got to be quite relaxed about how these relationships work. Example 11, the opening inventory is given, the closing inventory is given, and using your percentages, you can work out the purchases as being the balancing figure, which of course derives from the cost of sales, which in turn comes from the selling price, etc. So that was quite an intricate little example. So do practice that again and again, that kind of thing. And example 12, very, very similar. If you've got your figures given to you of opening inventory, purchases and closing inventory, and you have your relationships with regard to gross profit, the gross profit is given to you as being 5% of a margin. So obviously 5% of selling price will be your gross profit, and then you just fill in the gaps. Very, very straightforward indeed. So there you are. We come finally to the bit about inventory being lost. I find that one of the most interesting exercises personally, because it's quite relevant in real life, you know. So the solution that we put together is where I would like to turn to eventually. As you can see here, sales, bring in all the information that you have got. Your framework of opening inventory plus purchases less closing inventory must never change. If you do a subtotal, as I've done here, it does make life a little bit easier, this little subtotal. Do a subtotal. And once that subtotal is in place, you'll realize that the cost of sales of 80 requires 12 to be taken out as closing inventory. But if you only have 3,000 physically counted, what happened to the other 9,000? Ah, yes, that's the one that was lost in the fire, or damaged, or stolen, or whatever it might be. So there you are. That's incomplete records for you. Quite an interesting exercise. The next topic on the agenda, once we get that organized, is of course partnerships, but I'm going to leave that for another session. Thank you.